Imagine lending $100 to a friend. You trust them, and they need the money for something important. You agree on an interest rate and a repayment date. This means they will pay you back the $100 plus a little extra for borrowing it. Your friend gets the money they need and you expect to receive your money back with interest. This extra amount is your reward for lending the money. This is a simple way to understand bonds. Bonds work on the same principle of lending and borrowing. A bond is like an IOU issued by a government or company. They need funds for various projects or operations. When you buy a bond, you're essentially lending money to the issuer. In return, they promise to pay you back with interest. The issuer promises to pay you back the principal amount, which is what you lent, plus interest over a set period. This period can vary from short-term to long-term. Just like lending to a friend, bonds come with varying levels of risk. Some are safer, while others are riskier. The risk depends on the issuer's financial health. A financially stable issuer is more likely to repay the bond. A stable government bond is like lending to a reliable friend, someone you know will pay you back on time. While a bond from a new company carries more risk, kind of like lending to a friend with a shaky financial history, you might get higher interest, but there's a chance they might not repay. Understanding this basic concept of lending and borrowing is key to grasping the bond market's workings. It helps you make informed decisions about where to invest your money. The bond market is where these IOUs or bonds are bought and sold. It's a dynamic environment where various entities interact to fulfill their financial needs. Think of it like a giant marketplace where governments and companies go to borrow money from investors. These entities issue bonds to raise capital for various projects and operations. Investors, like individuals and institutions, come to the bond market looking for investment opportunities. They analyze different bonds to find the best fit for their portfolios. They buy bonds that align with their risk tolerance and financial goals. Bonds can offer a steady income stream and are often considered safer than stocks. The bond market operates on the principles of supply and demand. The interaction between buyers and sellers influences bond prices and yields. When demand for bonds is high, prices rise and interest rates fall. This can make bonds more attractive to investors seeking lower risk options. Conversely, when demand is low, prices drop, and interest rates rise. This scenario can deter some investors but attract others looking for higher returns. This interplay between buyers and sellers determines the price of bonds and the interest rates they offer. It's a complex but fascinating market that plays a crucial role in the global economy. The bond market has a significant impact on interest rates throughout the economy. When bond prices rise, interest rates generally fall, making it cheaper for individuals and businesses to borrow money. This can have a cascading effect, leading to increased spending, economic growth, and job creation. Lower interest rates also make mortgages and other loans more affordable, stimulating the housing market and consumer spending. For investors, bonds offer a way to earn a fixed income stream. They are often seen as a less risky investment option compared to stocks, especially for those seeking stability and predictable returns. Section 4. Beyond the dollars and cents, the bond market's broader impact. The bond market's influence extends beyond the realm of finance. It plays a vital role in economic stability by providing governments and corporations with the necessary funds to operate and invest. When governments need to finance infrastructure projects, social programs, or respond to crises, they often turn to the bond market. Similarly, companies rely on bond issuance to fund expansion plans, research and development, or manage their debt. This access to capital is essential for economic growth, job creation, and overall societal well-being. A healthy bond market is crucial for a thriving economy. Section 5. Players in the bond game, from governments to grandparents. The bond market involves a diverse group of players, each with its own motivations and objectives. These players range from large institutions to individual investors, each contributing to the market's dynamics. Governments, both domestic and foreign, are major issuers of bonds. They play a crucial role in the bond market, influencing interest rates and economic policies. They use bond proceeds to fund public services and manage their national debt. This includes building infrastructure, funding education, and maintaining public health systems. Corporations issue bonds to raise capital for various business purposes, such as expanding operations, investing in new technologies, or refinancing existing debt. This allows them to grow and innovate. Investors, ranging from individual retirement savers to large institutional investors, buy bonds seeking a steady stream of income and capital preservation. Bonds are often seen as a safer investment compared to stocks. Understanding the roles and motivations of these key stakeholders is essential to navigating the complexities of the bond market. Each player has a unique impact on the market's behavior. By understanding how the bond market works, individuals can make more informed investment decisions and understand its broader impact on the economy and their daily lives. This knowledge empowers investors to better manage their financial futures.